Oh man, here we go again. The housing market has been declining over the last 8 months. Interest rates are over 6%, approaching 7%. Housing affordability in the United States has fallen to its worst level for 37 years. And banks are now starting to offer no money down loans again. There's a catch though. It's only for certain buyers in certain cities. I'm gonna reveal the hidden truths about these types of loans. Get ready for the truth about what's likely gonna happen as these buyers are still struggling to get homes with interest rates being so high. Some banks are now resorting to zero money down loans in an attempt to qualify normally unfinanceable Americans. Is this a good thing? The thought process behind why the banks are offering these type of loans is really to try to help low income and first-time homebuyers achieve the American dream. Who doesn't want to live and own their own home, right? The concern is that will this cause a market correction and a foreclosure crash like we saw back in 2008 and 9, where properties were going into foreclosure down at the courthouse steps here in San Diego, 500 to 700 homes a day. Do you qualify? Stick around until the end of this video and I'm going to answer that question for you. The debate is whether or not this type of loan program is going to cause another market crash similar to the ones we saw in 2008, where the homeowners would just end up owing more than their home's value when they tried to sell it. Most people don't even know that these type of loan programs exist and who can qualify for them, but they're about to find out. And while it might seem like it's very attractive at first glance, there is a downside to consider. Bank of America is the first bank to start offering this type of loan program. They're claiming that they want to help low-income earners in certain few pilot cities to test this out. The program offers several benefits like zero money down, zero private mortgage insurance, no closing costs. They're not even going to check what a minimum FICO score that you're going to need to qualify. Instead, Bank of America wants to do this new special type of credit program where they take into account factors like timely payment of your rent, payment of your utility, your phone bills, and then what they do is they put it into some Bank of America calculation algorithm and they come up with their own unique FICO scores that they're going to use to determine whether or not these borrowers will be eligible. This program is solely based on income and home's location, but the buyer still needs to complete a home buyer's course that is offered by both Bank of America and the Department of Housing and Urban Development. Opponents of this program are concerned, especially considering the predatory lending practices exhibited by some of the banks in the past. Banks such as Countrywide gave out loans to borrowers using stated income and negative ARM loans. During that time, real estate was appreciating 20% a year from 2002 to 2006, fueled by what we call subprime loans. Sorry to interrupt, Scott. Can I have a second? I realized while editing this video that many people may not be fully aware of what subprime loans are and how it worked prior to the 2008 market crash. The first subprime loan was issued in 1988, and it was issued by a company called Guardian Savings and Loan. Soon after that, another brokerage company, Long Beach Mortgage, began to copy them and then issued more and more of these subprime loans. And the funny thing is, these employees of Long Beach Mortgage started to go out and start their own companies to offer more subprime loans. Then in 2002, because of low interest rate, a strong economy, and the expectation that housing prices would continue to go up, allowed borrowers with poor credit to qualify for these subprime loans. So what is subprime loan? Basically, subprime loans are loans that were created by banks in order to give mortgages to borrowers that ordinarily would have never been able to qualify to get a loan in the first place. The reason is they have poor credit, low income, and chances are they don't have any money to put as a down payment. So banks created these type of loans in order to give these high-risk borrowers a chance to get a mortgage. So why are subprime loans bad? One thing is that lenders do agree that candidates for subprime mortgages are more likely to miss payments and default on their loans than borrowers with good credit. And because subprime borrowers seem to be a greater payment risk, lenders typically charge them a higher interest rate and more fees. Now you may be wondering why this wasn't a problem in 2002. The reason these loans weren't a problem was because prices continued to go up and up and up. If rates adjusted, people can simply refinance into another subprime loan. And even if they couldn't refinance, they could have just sold their property and taken a nice hefty profit. So this was fine when prices continued to go up and up and up. However, as interest rates continued to rise because of the adjustable rate mortgages, there were more people holding homes than there were legitimate buyers that can afford to buy them. When the house of cards fell, people that had these risky loans just stopped making their mortgage payments. Companies like Lehman Brothers, Washington Mutual, Countrywide, they all went bankrupt. Trillions of dollars worth of mortgage-backed securities, known as MBSs, all started to go underwater. This problem was so systemic that countries like Iceland, Ukraine, Argentina, and Jamaica all went bankrupt because they invested in these MBAs. Everybody back then thought these MBAs was a sure thing. Now we know better. When the rates started to adjust and go up, the monthly loan payments for these borrowers started to increase to a point where they couldn't afford to make the loan payments and they ended up defaulting on their home. Adding to this problem was the fact that so many of these loans were stated income, allowing the borrowers to lie on their loan, saying that they could make more money so that they can qualify for multiple properties. This speculative frenzy ended up in a disastrous result with the largest foreclosure market that ever hit the real estate industry. Thankfully, today's market differs significantly from what we were seeing in 2008. In 2018, the Senate passed the Dodd-Frank Act, which basically regulated the banks and their lending practices, eliminating all the subprime loans. Borrowers are now required to demonstrate their income and creditworthiness to obtain a mortgage. This has basically been true since 2018, and as a result of that, highly qualified buyers are now purchasing homes. Home prices have continued to rise even during the COVID-19 pandemic, primarily due to the Federal Reserve lowering their interest rate. Additionally, many of the borrowers took advantage of this historically low rate, either to purchase a new home or refinance their old loans. As we all know, the Federal Reserve raised interest rates in an attempt to curb inflation. And by 2023, most of these homeowners have built up so much substantial equity in their home that they're not likely to foreclose. However, this rise in housing prices have led to millions of potential home buyers not being able to afford to qualify for a loan because homes are now just unaffordable for most Americans. This is why Bank of America is offering these zero down payment options simply to help home buyers enter the housing market. So this leads us to a very important question. Is this type of loan going to cause a foreclosure crisis? My answer is no. The reason for this is loans like this already exist. The FHA loan basically has been around for decades and has allowed borrowers to put as little as 3.5% down. And VA loans, you don't even have to put any money down. There are zero money downs for all the VA. The primary concern with minimal down payment loans like these is that if the buyer experiences a job loss, a market downturn, or unforeseen circumstances, this can force them to sell at a possible loss. Even though this is a real possibility, the actual chances of this happening is so small that it really doesn't affect the market in a negative way. I really have mixed feelings about this type of loan program. On the one hand, I can see that potential low-income borrowers can be victimized. However, on the other hand, really, this loan program might be the only option that a lot of people have in order to achieve the American dream of home ownership. If you want to know whether or not you can qualify, I've left a link below and you can reach out to me. I'll put you in touch with a Bank of America lender who can then help you figure out what your qualifications are. And if you don't qualify for this loan, don't worry. There are other types of loan programs that you might be able to qualify for besides this one. Thank you for tuning in, and I hope you found this video informative and valuable. Your feedback is greatly appreciated, and if you have any real estate topics that you would like to learn more about, let me know in the comments below. I'm Scott, and you've been Real Estate Informed.